Welcome back to Morning Trade Live. It's time to go inside out on Zoom Communications, the software company. You remember Zoom, of course, right? So we see we're watching for the earnings after the close. Stephen Dickens, CEO, principal analyst at Hyperframe Research. I mean, this stock went from $92 down to 71 bucks. It's at a recent low of at least since late of the year, pretty much. It's hovering around the lows of the year. Where do you think Zoom is headed and why?
So, Nicole, I think the things I'm going to be looking for when they announce earnings after the bell, the company's got to be part of that AI overall uplift we're seeing in the market. They've been trying to position themselves as an AI first company, trying to shake off some of that pandemic sort of association that you mentioned in the kickoff there. I think it's how do they start to become more an enterprise AI story, meeting summaries, live translations, generative AI tools. If they can capture that zeitgeist, that's going to be valuable and start to represent itself in the stock. I think the challenge is going to be how do they drive beyond just the core use case of meetings and start to expand that footprint.
Yeah, they talk about the possibility of more calls, more opportunities for agentic AI and virtual agents for the Zoom phone. This is not the Zoom of our pandemic, right? It has evolved. Has it evolved enough?
Well, I think the key thing for me is how do they expand the footprint? One of the key metrics I'm going to be looking for on the earnings call later today is the push-up market that they've been doing. They've got a clip level for those customers spending over 100K. The numbers of and transparency there that is a key indicator of whether they're being successful. The other thing we talked about there was the diversification of the portfolio, getting beyond just the classic meetings. We're actually on a Zoom as we speak, but how does the company push into Zoom contact center? They had an abortive attempt to buy Five9 back in 2021. That was obviously a clear push to drive an expanded base and an expanded value proposition to their clients. I think what they're going to need to do is continue that journey. We see Microsoft with Teams, we see Google in this space. So they're competing against people with a very broad portfolio and other solutions in their stack, and that's going to be the challenge.
And look, Skype is gone. There must have been a few people using Skype that had to use something else, whether they chose Zoom or Teams or whatever, right? I mean, I don't know what kind of market share that represented. Yeah.
Yeah, we've seen some consolidation. Amazon's largely pulled back from Chime, its solution that it's had in this space. We've seen others fall by the wayside. So I think there's been a consolidation. I think the piece for me is, can Zoom become a platform story as part of how they engage with these larger enterprises? Because that's the competitive vector against people like Google with their Meet product that's baked into Workspace, or others such as Microsoft with Teams, obviously.
And Oracle, I know you've been watching this name. Is Oracle back? It's working with AI, OpenAI, NVIDIA, working on turning around its cloud biz. While you seem a little cautious on Zoom, are you more optimistic on Oracle?
Absolutely bullish on Oracle, Nicole, on a number of vectors. Their partnership strategy, what they're driving with Oracle database and cloud infrastructure in other hyperscalers. They've now cemented partnerships with AWS, with Google, with Microsoft. That's from a data centricity perspective. So I'm really bullish there. I think also the trajectory the company's on, they recently made some announcements about partnering with Google for Gemini, really solid around their AI strategy. So I think you've got the core fundamentals of Oracle, lots of data centricity, that's coming through with their database. You look at what I think they've had a balanced ride of it with Cerner, but that's starting to come through as well. Healthcare is going to be a laggard as it comes to AI, but Oracle's really well positioned with Cerner and the electronic health records that are in that platform, arguably the best player in that space. Then you look at apps, they've got a really good story. So whatever vector you look at from an Oracle perspective, whether you look at the core infrastructure, you look at database, you look at healthcare, you look at their sort of other app story, firing on all cylinders for sure. So I think we're starting to see them established as that fourth hyperscaler. There was recent market commentary from other analysts in the space. It's absolutely putting them as a leader, and that's starting to reflect itself in the stock. So I think only up from here is the way I look at Oracle.
And meantime, it's up about 40% this year. The high was 260. It's at 233. Any thoughts on valuation, or where could it go back to those highs, gaining $30 again?
Well, I don't look at the valuation, Nicole, and I don't track it from a stock level. I'm just looking at the fundamentals of the technology strategy and where they are from an execution point of view. Ruthless execution. Larry's still got his hands in this. Larry Ellison, that is. Solid execution. I spend a lot of time with the executives over at Oracle. Really, really impressed with where they are from a cloud trajectory point of view. They're now in really solid execution mode. So I look at those technology fundamentals. That will reflect itself in quarterly earnings. So earnings per share and the trajectory. This is a really well-run business. They report earnings within 10 days, typically, of closing out the quarter. That just shows really strong discipline. Also proves out the value proposition for some of their enterprise software capabilities that they sell into CFO functions. But really positive on the technology with Oracle. Fundamentals of where the AI landscape is going to be. Lots of enterprise customers are worrying about data curation and data sovereignty. Oracle's got a great story there. So long term, that's obviously going to reflect itself in the earnings.
Stephen Dickens, CEO, Principal Analyst, Hyperframe Research. Thank you so much. Good luck there at Zoom and at Oracle as well. Names that are going to be in focus. And so we'll have some example trades for you now. Tom White, host of Fast Market, is joining us. First up, we take a look at Zoom, which here I'm seeing how it went from $92 down to $71 over the last year or so. Some of your thoughts on an example trade. Good morning, Tom.
Hey, good morning, Nicole. Yeah, implied volatility levels pretty elevated going into this report. The option market's pricing in about a plus or minus 7% move in the shares. And I think one of the key things is the partnerships that they're creating across the board, because as your guest noted, there's a lot of competition in this space. But they've got really high margins at this point, some of the highest in the industry at this point. So I looked at it this way, where I want to take advantage of the dispersion between implied volatility levels while not having to pick a direction. I just think maybe it's going to move post earnings. About that one standard deviation move, which is just about $5 either way in the stock. So I looked at a double calendar position where I'm going to go out to the August 29th weekly options that expire in just 8 days. I'm going to buy an out of the money 77 strike call on the upside, and then I'm going to buy an out of the money 67 strike put. So I'm buying those in the August 29th weekly options that expire in 8 days, and then in the August 22nd weekly options that expire in just 1 day, I'm going to sell those same strikes, the 77 call and sell the 67 put. So it's about a $10 wide double calendar position. I'm going to pay roughly about 50 cents a debit for this double calendar position. That's going to be your risk, $50 per spread. So you're not outlaying a bunch of capital and having a bunch of risk on this type of position. You're only paying 50-cent debit because of that vol dispersion that I mentioned. You're buying basically in the August 29th weekly options on aggregate. You're buying about a 74% implied volatility. And then in the near-term options, where you're selling those same strikes, a 67 put and 77 call, you're selling about 160% implied volatility. So that dispersion really lowers the entry point price. Now, you want it to go either towards 77 tomorrow or down to 67 over the next 8 days in this position. So that vol dispersion lowers the price entry point. You don't have to pick a direction. You just want it to move about that one standard deviation. But you still have a decent range, Nicole, between about 62 on the downside and about 83 on the upside, where you can potentially remain profitable on this type of trade. So it's two apexes of profitability you see right there. The things that you don't want to happen, Nicole, you don't want it to stay right where it is, and you don't want to get an outsized move, maybe $10 either way, or 2 standard deviation move, because that's going to start to dig into any profitability that you might have and start going into losses. But the key thing is you're only risking $50 per double calendar on this strategy.
All right, explaining the trade and telling you what you want and what you don't want in order to make some money there on that trade. Let's talk about Oracle, a name that has come off the recent highs of 260. It's down about $30 off those highs, but still has been a real great performer. And you just heard our guest, Stephen Dickens, speaking so positively about this name. How would you go about an example trade?
Well, yeah, you can tell that 10% pullback that we've seen from those all-time highs just last month, it tells you that Oracle is not immune from pullbacks in the overall market, even though, their past few earnings reports have been spectacular. Their remaining performance obligations continue to grow over 100% at this point on a quarter-by-quarter basis. So that's the positives here. But like I said, they're not immune to it. So I looked at a strategy taking advantage of the pullback. The pullbacks also increased implied volatility levels. So I looked at a risk-defined strategy where I'm selling a put vertical to take advantage of a neutral to bullish stance here in case the market does sell off, because as I mentioned, Oracle's not immune to those types of moves. So going out to the September 5th weekly cycle. So why did I go out there? Well, they report earnings the following week. So I want to avoid that event risk, but maybe the stock rallies or consolidates prior to that earnings event. So selling it out of the money put vertical, selling the 225 strike put, buying the 215 strike put, short $10 wide, neutral to bullish put vertical. I'm going to collect roughly about a 230 credit on it. $230 per spread is what I can profit on it. I've got $770 in risk, but that's all the way below 215. Now, if I collect that 230 credit, it takes my break even down to 222.70 over the next 2 weeks. That's about 5% below the current share price. So, if you look at this in a baseball analogy, Nicole, you're trying to hit a single, trying to hit a double, not swing for the fences because of the added volatility that we're seeing right now and that we typically see in August and September.
Okay, good to know, right? You don't always have to go for the home run.
Yeah.
Good to see you, Tom White. Great example trades every single day here on Morning Trade Live. Thank you.